Good morning and welcome. Welcome to the 36th Annual College of Business and Economic Outlook Conference.
Pollack has been doing this for a number of years as well. He's the CEO of Elliott D, Pollack & Company, an economic real estate consulting firm in Scottsdale. The firm maintains the most comprehensive database of real estate information in Arizona. And Elliott is going to talk to us about state and national economic issues. Elliott?
If you look up on the screen, for some reason we got it wrong. We thought this was the 37th Annual Economic Conference. I apologize. I guess I'm not that good with numbers. I'll tell you one quick story. I was hired by Valley National Bank a long time ago, and the guy who interviewed me was a guy named Len Hupp, who's still around. He was been a banker for years. And we had a long conversation. I had gotten out of graduate school, and I got done making the world safe for democracy, and I was looking for a job. And so I talked to Len for about an hour. At the end of the conversation, he said, I got one question for you. How much is 7 times 6? And I said, well, 45. And I walked out. And on the way out, I said, well, geez, how did I make that mistake? 7 times 6 obviously isn't 47. 45 is 42. So I got a call a couple of days later from Len, and he said, you know what, you got the job, congratulations. And I said, well, let me ask you a question. He asked me how much 7 times 6 was, and I said 45 instead of 42. Why did I get the job? He said, well, of all the economists I spoke to, your answer was the closest. The right one? Okay, here we go. At any rate, let's talk about economic conditions. The definition of insanity is doing the same thing over and over again and expecting a different result each time. Well, a week ago we had, as both Ron and Dennis pointed out, we had a president who can't lead and can't compromise. We had a Republican House that can't lead and can't compromise. And we had a Democratic Senate. And now we're going to have the same thing for the next 4 years. So to expect something different would be insane, okay, as far as I'm concerned. At any rate, this is what the economy we wanted and we expected, and this is what we got. And it's only because economic conditions have been so poor for so long that people are okay with it. Just like the 30s, you kept on re-electing Roosevelt, even though things were lousy because they looked like they were getting a little better, right? So what's the future hold? The answers are pretty obvious as to what's going on. You're going to have subpar economic growth, but the recovery should continue unless the federal government does something stupid. Now, far be it from the federal government to do stupid, but this fiscal cliff thing is kind of amazing to me. And that's simply because, as Dennis pointed out, the CBO thinks we'll go back into recession. On January 2nd, the Bush-era tax cuts end. That means $330 billion out of the system in 2013. And it means $500 billion in defense cuts alone over the next 9 years, $55 billion in 2013. That's going to have a major impact on Phoenix and Tucson, and therefore, by definition, the rest of the state. And we'll talk about that at length. But at very least, it causes great uncertainty. And the cost of non-resolution would be simply draconian, simply insane. So I'm hoping that there's some type of resolution, but then I'll go back to my original statement that to expect a different result from doing the same thing is insane. So I don't know what to think. There's also another issue, and that's Obamacare, right? In effect, here comes Robert. I'm done, Robert. You can come up.
I like the first slide I watched YouTube. It's so clever. Thanks.
At any rate, this was a statement, it's quite a lengthy statement, the longest sentence I've ever seen, actually, by a state senator from Illinois, of all places. She said, we're going to be gifted with a health care plan that we're forced to purchase and fined if we don't, which reportedly covers at least 10 million more people with adding a single new doctor, but provides for 16,000 new IRS agents. That's not quite true. We'll talk about it. Written by a committee whose chairman says he doesn't understand it. Passed by a Congress that didn't read it, but exempted itself from it. Signed by a president who smokes. With funding administered by his treasury chief who didn't pay his taxes. For which we will be taxed for 4 years before there's any benefits that take effect, by a government which has already bankrupted Social Security and Medicare, all to be overseen by a Surgeon General who is obese and financed by a country that's broke. So our question was, what could possibly go wrong? So the bottom line is that this is creating a great deal of uncertainty. Nobody knows what it's going to cost. Nobody knows how the implementation is going to take shape. And as Dennis pointed out, uncertainty is the enemy of business. Business can last if they know what the ground rules are. But without knowing the ground rules, people tend to pull back, and that's what's going on right now. By the way, even the President and the Chief Justice can't agree, because the President says it's not a tax, but the Chief Justice says it is. All right? I didn't know where the Chief Justice got his economic training, by the way. Certainly not at NAU. At any rate, as you can see, this is GDP since 1970. The only reason I'm throwing this in is you can see that this recovery, by any historic standard, is weak, and we'll talk about that. But at least we're growing, and so it should continue, but it's going to be continued at a subpar rate. We'll talk about this. Consumers' spending is going to be up, but it's going to be modest. Business spending is going to be up, but because there's excess industrial capacity, it's not going to be up rapidly. There's going to be a continued housing recovery. You're going to get large percentage gains, but they're small in numbers because we're down so far. Limited commercial construction, continued pressure on state and local government, and again, as far as I'm concerned, the federal government has very few policy options left. I don't know where they go from here. Let's talk about consumers, all right? Good news for consumers, they've been deleveraging like crazy. In the last 4 years, consumers paid down $1.7 trillion in debt, and the financial obligations ratio is down to levels that you haven't seen since the early 80s. This is how much of people's income they use to pay for previously accumulated debt. Obviously, the more you're paying for previously accumulated debt, the less money you have to spend. Well, that's coming down. And as you can see, consumers spend a lot of time paying down debt in this recovery. And now that it's growing again, it's growing at rates that you don't see the big spikes that you had after previous recoveries. That's kind of good news. On top of that, while employment's been mediocre, it's at least growing. And hours worked is up. Again, not by much, but you have enough to get confidence up. By the way, the bottom in confidence, it's been improving ever since Arizona passed the medical marijuana law. But thought I'd point that out. In addition, there's a lot more refinancing going on, and that means, again, consumers have more money. There's also a wealth effect. Housing prices in Phoenix are going up, and going up rapidly, but it's not as good as you think. We'll talk about it. And up until recently, the stock market had been up, and those things are all positive. So again, jobs are being created at a slow rate. Those that have jobs are going to spend a little more money, but they're probably going to remain cautious. Unemployment's going to remain high, but trend lower. The wealth effect's improving. And again, it's just all the uncertainty that Congress and the President can't seem to clarify. Business has paid down $2.9 trillion in debt over the last 4 years. They're in really good shape. Corporate profits, while they're off the peak, are very high. Spending on equipment, mainly about 2/3 of business equipment spending is computers and software, and that's growing, not rapidly, but it's growing. Business spending on plant, though, isn't doing all that well. Why? There's still excess capacity. You're below the levels at which historically you've had booms in capital spending. And that will happen, but probably not this year. So again, business is in good shape. Spending on equipment is going to continue to grow. Spending on plants is going to lag until capacity utilization gets higher. And employment should continue to grow, other things being equal. That brings us to the problem sector, government. Okay? Let's talk about the government. Okay? The government has increased its debt $5.8 trillion over the last 4 years, thereby absorbing all the benefits of the private sector. And again, we are now borrowing, I'm just going to throw out these numbers. We're borrowing 34 cents out of every dollar we spend. And you can't simply collect enough taxes to make that up. Here's why. Here's the receipts. Basically, there's about $2.5 billion in receipts, about $1.2 trillion is individual taxes, about $200 billion is corporate taxes, Then you have Social Security and Medicare, unemployment insurance. That's basically the government's receipts. Expenditures, however, mandatory receipts, are mandatory programs, Medicare, Medicaid, Social Security, TARP, things that they say we can't touch, is almost $2.3 trillion. The discretionary programs, basically the military, the defense, Homeland Security, Department of Energy, Department of Education, everything you traditionally think of as government, everything else is about $1.3 trillion. Well, let's do the math here. If you've got expenditures of roughly 3.8 and receipts of roughly 2.5, you got a deficit of about $1.3 trillion, which interestingly enough is exactly how much you have in discretionary expenditures. So that simply means if you completely shut down the government, you got rid of every soldier, you got rid of Janet Napolitano, which is not a bad idea, by the way, and you got rid of the Department of Education, the Department of Defense, you got rid of everything you traditionally think of as government, you still would barely have a balanced budget. That's what type of hole we're in. There is no way out that's easy. And so, by the way, Obama's budget is for $16 trillion in debt this year and $26 trillion by 2022. So it's not getting any better, and his assumptions are overly optimistic, in my opinion. So, at what point is this a problem, okay? There's a tipping point. There's a point, you know, we've gotten a free pass because we're the world's reserve currency, and there's no alternative. And people still send their assets here in times of uncertainty. But at some point, that will change. The problem is, it's just like the housing bubble. You know it's a problem. You don't know when it's going to strike. You won't know until it happens. So, and just like Dennis's inflation, you know it's a problem. You know it's out there. The Fed says, oh, we can take care of it. Of course, they've never done this before, so the odds of them taking care of it are slim, but you don't know exactly when it hits. Same thing with the world basically saying, we don't want your debt anymore, or we want much higher interest rates to hold your debt. Especially since, logically, every other government in the history of mankind has inflated its way out of these problems, and I doubt that this one will ultimately end differently. So, what does the government need to do about this? First, you have to admit there's a problem, and then you have to actually deal with it. And the reality is it's going to be painful. There's no easy way out, and nobody's going to be happy. You're going to have significant cuts in the rate of these mandatory programs. You have to. You have to have tax increases, but hopefully they don't hurt incentives. But you can't have significant cuts or tax increases in this type of weak environment because they'll throw the economy back in a recession. It has to be phased in over a long period of time. It takes compromise and statesmanship, and those are two things that don't exist in Washington right now. I'm not optimistic. So the government summary is state and local under pressure. More revenues available this year. Federal government spending will be up but more slowly, and you need to avoid this fiscal cliff or all bets are off and we're going back in a recession. I will also say very briefly, I don't think that Europe is going to throw us back into a recession. I think, you know, it's scary, but I don't think it's going to happen, quite frankly. So, national summary, consumers are still restructuring, confidence is improving, business is in good shape, but there's no confidence because of low capacity utilization, the cost of Obamacare, the potential fiscal cliff, just to name a few, and there's no leadership of the government anymore. I hadn't thought of it as the way Ron put it, where essentially it's no longer statesmanship, it's no longer politics, it's dogma, and that unfortunately is true. Let's talk about Arizona, all right? Arizona and the U.S. economy move together. We tend to grow a lot more rapidly during periods of expansion, and I think that's the case now, although, as you'll see, even though by our standards it's very mediocre. In 2006, we were the second most rapidly growing state. By 2009, we were 49th. Last year, we were 23rd. We're all the way back up to 6th. And by the year end, we'll probably be about 4th in growth. And quite frankly, there's little here that isn't transitory. Most of it's cyclical. The reason you don't recognize any of those people is they were all transitory as well. So how'd you go from 2nd to 49th? Well, again, I went over this last year, but I thought it was worth going over again. You had a financial meltdown and a credit freeze. At the same time, consumers were overextended. You had this excess supply of housing. So housing prices declined. There was a negative wealth effect, and people couldn't sell their homes in Michigan or California to move here. People couldn't retire because their 401ks were decimated. So population flows went down to literally nothing. And as a result, housing prices even fell further, which weakened population flows even further. We'll talk about household sizes increasing in a minute. Excess commercial construction, because all the apartments and offices you built, there were no takers for them, and so job losses were pervasive throughout the economy. How do you go back from 49th to 2nd? Well, the economy starts to improve nationally, the stock market improves, credit frees up, and as tough as it is, it's actually freed up a little. Consumers become more confident, people start moving here again slowly, and the part that I didn't have last year that really is important to this analysis is investors help absorb the excess supply of housing. We'll talk about that. Excess housing is absorbed, prices start to increase, construction kicks in, and then you reverse the process you're in, things start to look pretty good. But it's going to remain slow. Why? There's a slow national recovery. Consumers, I don't think, are done restructuring. Confidence levels have a way to go. There's going to be a winding down of the defense sector no matter what you do. And again, right now, 40% of the U.S. population is not mortgage credit worthy, and as a result, they're not going to be buying homes. And then more than 39% of homes in Arizona are underwater. That's down from where it was, but it's a problem. Now, as you can see again, we went from 49th to 6th. That's a great improvement, despite the fact this is a terribly slow recession here. So I can't imagine what it's like in other parts of the country. You're going to have 2% growth this year in employment. If the fiscal cliff goes away, you'll have 3% next year. If it doesn't go away, it will be negative. That's a hell of a forecast, but I'm afraid that's the way it is. So let's talk about the fiscal cliff. All right? This is what the defense industry will look like if it was. At any rate, the projections, our projections are that the state will create 48,000 jobs this year, that's 74,000 next, and about 88,000 in 2014. Studies done, independent studies by the way, say the loss because of the defense sector alone will cost the state 45 to 50,000 jobs. That doesn't take into account any slowdown caused by the tax increase that will take a bunch of money out of consumers' pocketbooks. Yes, even guys in the upper 1% spend money, and therefore it still is going to have an effect on the economy. We'd still grow, but it would be painfully slow. And it might even throw Arizona into recession. Hopefully this never happens. In addition, U.S. Airways is about to, this never comes up, but U.S. Airways is about to merge with American. Where do you think the home office is going? Probably not Tempe, okay? That's a real problem. Also, Dallas, you know, American has hubs in Dallas and Los Angeles. Do you really think they need 3 hubs, Dallas, Phoenix, and Los Angeles? It's going to be an issue. I don't know what the answer is to that. I talked about that one. In terms of virtually every sector except for 2 small sectors are growing, and that's good news. The jobs are in professional and business services, trade, transportation, and utilities, education and health services. Even leisure and hospitality is doing very well. Construction's up, manufacturing's even up a little. So it's pretty broad-based. I just want to give you a perspective of why you feel better, to see where we've come from. Over the last 12 months, we've added 57,000 jobs. 12 months before that, we added 48,000. 12 months before that, we lost 28,000. The 12 months before that, we lost 207,000 jobs. So, in essence, we've gone from a negative 207 to a positive 57. That's why things feel a lot better. We've lost, from peak to trough, from November of 07 to September of 10, we lost 312,000 jobs in the state of Arizona. We've gained back about 105 of them, so only about a third of the way back. We think it'll be 2015 before you get back to where you were in 2007. Essentially, the state has had a lost decade. Now, what I did here is take a look at the previous 6 recessions, and the recoveries rather, and the 3 years past the end of the recession to see what happened to employment. And as you can see, every recovery we've had, even during after weak recessions, the recoveries have been much stronger. This has been a weak recovery in overall employment, construction employment, manufacturing, trade, services. By every standard, it's a weak recovery, yet we've gone from 49th to 6th. What does that say about the rest of the country? Now, population, these are the forecasts. The fact is that nobody knows for sure what the population is going to be because nobody can project when housing prices improve enough and credit markets free up enough for people to start moving here en masse again. And that means, since a lot of those these jobs are population-based, we don't know exactly what employment's going to be, but these are the long-term forecasts. We tend to believe them, but there's a high degree of uncertainty connected with it. Population looks like it's starting to improve, but only slowly. This is SRP, net residential utility hookups. It's still only running about 1%. Same thing with APSs. This is, by the way, what you're looking at is 50 years of data here. Actually, almost 60 years of data. And obviously, 2009, 10, and 11 were the weakest years on record. 2012 so far has turned around, but only a little. So that's a major problem. School enrollment, interestingly enough, actually declined in 2011 and is starting to improve again, but way below what we should normally expect. Let's talk about housing, right? It's all about supply and demand. Housing, it's not a light switch, it's like a dimmer switch. It's going to get progressively better. Now, why are homes? Now, this is our set of projections, which is for about 12,000 this year, 14,000 next, then 18, then about 25 in 2015. Which by historic standards is pretty weak, but relative to the 6,800 we had last year is just great. And we had 6 years in a row in decline, and this year you're up about 76% in the greater Phoenix area. I just want to use this as an example of numbers, right? If you decline almost 90% from peak to trough, and you recover by 76%, well, that's not very good, and here's why. To get to the previous peak of 63,000 units, you actually have to grow 835% from the trough. Just to get back to the long-term trend of 30,000 units in Greater Phoenix, you need to grow by over 340%. So it's good, but it's got a way to go. In terms of supply, just like here, the number of units in MLS is dropped dramatically. The month supply has dropped dramatically, but it's very specific. In Phoenix, the real tight markets are below $150,000. Who's in that market? Investors. That's what they're buying. And there are investors in Phoenix coming in buying 1,000 or 2,000 homes a pop. In essence, that's what's driving demand in Phoenix. Let me get to that one. I'll come back to this in a second. About 42% of all the homes in Phoenix are being bought by non-owner occupants. That's good because most studies say that if you have 2 kids and a dog and you lose your house, or you mail in the keys, you're not going to an apartment, you're going to a rental single-family home. So there's a lot of demand for that. By the way, this is why home builders are so happy in Phoenix. This is from 2008 forward. And as you can see, you're back to 2008 levels in terms of permits. They're jumping up and down because it's such an improvement over 9, 10, and 11. And there are so few builders in Phoenix, they're splitting up the pie between much fewer people. On the other hand, let's give it some long-term perspective. This is from 2003 forward, and what happened in 2012 looks like a blip on this chart. Okay, talked about that. Foreclosures. Foreclosures are actually going down as a percent of sales. Short sales are staying steady as banks have figured out how to do that and do it well at this point. But Arizona still has a lot of people underwater, and they're not in the market. In fact, we figure that about 58% of the people of homeowners could be in the resale market because they have an LTV of less than 80%, so there's some equity there. But there's about 42% of the households who are simply out of the market because they have more than an 80% LTV, little or no equity. And so that's going to keep the housing market a little weaker. On top of that, we talked about how many aren't creditworthy. Until these things get resolved, population growth rates are going to be anemic, and that means growth is going to be anemic overall. As housing prices go up, more and more people are going to be able to sell their house and move here. That's when things will start to take off. Let's talk about household formations. This horrible thing happens. You get a knock at the door and it's your 23-year-old kid wanting to move back in. Actually, when my youngest kid graduated, I moved and didn't leave a forwarding address. They tracked me down like a mad dog anyway. And there's a lot of pent-up demand. This is the percentage of people 25 to 34 living with their parents. It's gone all the way from 36% to 43% through 2011, which is the latest data available. The reason they can't launch is they can't get a job. Once jobs come back, they'll launch, and there's going to be a lot of demand for low-end housing and for apartments. So the recovery, once that happens, once the unemployment rate probably gets below 7%, is going to probably take off. Number of vacant single-family homes getting back to the trend, that's good news. So what's the result? I have no reason why I threw this chart in except I thought it was fun. Hi. What's going on with prices up here is not surprising. Resale prices are up 30% in Phoenix. That's what you read about. New home prices are actually down from a year ago, and non-distressed prices, those homes that are selling that are not distressed, not short sales, not foreclosures, those prices are actually flat from a year ago. It's just again, the stuff where the investors are that's pushing up prices. And again, if you take a look at this, the big price increases are below $200,000. The stuff above that, the prices are not increasing very rapidly. So it's basically distressed properties. To get to the long-term trend, by the way, housing prices have to increase by a lot. When will that happen? If all goes well, there's no fiscal cliff, 2015 or 16. Housing prices have a long way to go, in my opinion. What's going on in the housing market? Again, I threw this in last year. I'm throwing it in again because I think it's important to understand. If you're a manufacturer or you're a retailer and you find yourself one day with a huge supply of excess inventory, what's the first thing you're going to do? You're going to put it on sale. How long is the sale going to last? Until you get rid of all that crap, right? Well, once the sale's over, and prices go back to where they were. That's what's going to happen with housing. All right, apartments real quickly. Vacancy rates are coming down. You're getting a lot of absorption. There's still 3,250 units in the pipeline, but relative to absorption, that's nothing. Vacancy rates are going to continue to come down in apartments. Office, on the other hand, while vacancy rates are going to come down, they're so high that the bottom line is there won't be another major office building built in Phoenix probably until 2016 or 17. Industrial, they're filling up rapidly. Vacancy rates are still high, but at least you're getting a lot of absorption, mainly big box users. This includes Intel, by the way. And there's a lot in the pipeline, so this market's doing well. Retail, retail is starting to come down. There was a huge negative absorption in 2009, 10, and 11. Why? Because all this retail was built in anticipation of rooftops that were never built, and as a result, retailers had to pull out. You're finally getting some decent absorption, very little change in inventory, so that bodes better for that market, but it's got a way to go. All right, so how is this all going to turn out? The economy is improving both in absolute and relative terms, and in the absence of the fiscal cliff, it will continue to. Is the glass still half full? I guess it depends on your point of view. Yeah, I guess the answer is yes. The growth is slow by historic standards because the U.S. economy is slow and because incentives simply are perverse at this point. There's too much uncertainty. So the economy, in my opinion, should continue to gain momentum unless there's something stupid that happens. These are two senators, by the way. There is a boom out there somewhere in Arizona, but not in 2013. Other things being equal, 2013 should be better than 2012. It should be up to about 3% employment growth. 2014, I believe, will be better than 2013. 2015 should be a very good year, and I guess that's the end of my presentation. Thank you.